Hi everyone, welcome to the Timing Research show for February 2nd, 2015. My name is David Kosmeter. I'm the creator of Timing Research, and today we are going to be talking about the 71st weekly report from Timing Research. So if you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports and you can download the current report there. So I have Dave Landry guest hosting for me again this week, and I'm going to go ahead and turn it over to him.
Thank you, David Kosmeter, and thanks to Trading Research for having me back once again this week. This week we have Cameron Yost of Dimension Trader, Rob Hanna of QuantifiableEdges.com. Rob's a good friend of mine, and you often, if you come to these shows, you hear me quote him on occasion, and sometimes I say nice things about him. And then we have Vince Vora of TradingWinds.com. Let's go to you first, Cameron. Tell us a little bit about yourself, your style of trading at DimensionTrader.com. I think everyone here is a friend of the show except for Vince. This is his first appearance. But Cameron, tell us a little bit about yourself for those who are new to the show, and tell us a little bit about DimensionTrader.com.
Sure, Dave. I appreciate that. I've been trading on and off all my life, and got serious about it about 10 years ago. Back in the day, I was in Denver in the penny market when we had our little oil boom in the 80s. It was a lot of fun to play that, to trade with that. But recently I've been trading futures, and I was using some software from Dimension Trader, and I liked it so much I went to work for them. And I do customer service over there at DimensionTrader.com. We've got an indicator-driven, a very unique indicator-driven system. It tells you, it's called Easy Trader, and it's called Easy Trader because it's very easy. It tells you when to get in and when to get out. We even have a automated entry system on the NinjaTrader platform, and it works very, very well. And later on, I'll tell everybody how to get involved in that.
Fantastic, interesting work. Okay, over to you, Rob. Rob is Rob Hanna of Quantifiable Edges. Rob and I go quite a ways back. We've been friends for a long time, and I really dig what he's doing. I respect his work over there at Quantifiable Edges. So let me turn it over to you, Rob. Tell us a little bit more about your trading style for those of us who don't know you, and tell us a little bit about QuantifiableEdges.com.
Sure. Well, I started Quantifiable Edges in 2008 or so. Actually, it was the beginning of 2008, and basically what I do is I use history and do market studies to help me determine my market bias, and then I'll take little systems I use to find mechanical setups, and I'll sometimes take those mechanical setups, and I sometimes won't, depending on my market bias that my studies help me with. And most of what I do at Quantifiable Edges is swing trading time frame. I also have another site called Overnight Edges, and that looks to get long or short at the end of the day and then get out the next morning. So that just looks at long-term overnight tendencies and when setups are good based on historical metrics. And I got some news about overnight edges that I'll share with you a little later on, Dave. But that's going to be working with another site now as well.
Oh, fantastic! Cool stuff. Yeah, I like the way you find the edge, and then you use a little discretion because we have brains in our heads, and it's good to kind of use a little, as far as the way my style is concerned, a little discretion on top of that. Vince, you're next up. Vince Vora of TradingWinds.com. Tell us a little bit more, or tell us a little bit about yourself, and tell us a little bit about TradingWinds.com.
Great. First of all, thanks for having me on, Dave. I myself have been trading for almost 3 decades. I used to run the trading floor for one of the largest financial institutions in the world for many, many years. Went on my own in 2004, 2005 and started developing my own trading systems and strategies. And then about 3 years ago, I got involved with TradingWinds.com, and I've been their head trader ever since. We focus mainly on U.S. equities and options, and we have several courses, and I can speak a bit more about that a little later, but we also have a pro subscription service where we issue nightly recap videos as well as issue our own trade alerts. And the main thing about Trading Winds is we're very conservative and we like to keep things simple. So every system and strategy we have is based on technical analysis and is very simple and easy to follow.
I fully agree with that. Einstein, didn't he say make things as simple as possible, but go no further? So I guess it's up to me now. Speaking of simple, I do keep things simple. I believe that when it comes to markets, you can only predict the short term, and as I often say, if it's cloudy and thundering, you have a pretty good idea it's going to rain soon or likely to rain soon, but you don't know if it's going to be raining this time next week or next year. So I like to trade reversion to the mean in the direction of trend, and that's a fancy way of saying pullbacks. I'm not a reversion to the mean fan, but someone once pointed out that that's what a pullback is because you're trading reversion to the mean direction of trend. So I have a 21-page report on that if anyone's interested, and I did a 7 Secrets to Success article this morning, which kind of dovetails in with that. So if anybody's interested in that, let me know. I can be reached at david@davelandry.com. And as far as the bio, you can get that off my website. I've been trading for over 20 years. I've been on both the institutional side and on the retail side of the business. And I was a commodity trading advisor, registered commodity trading advisor for about 14 years. Over the last, I guess, 15 years or so, I've gravitated more and more towards stocks because I think with stock market you could find inefficiencies that don't exist in some of these more efficient markets. I'll still trade forex. I've got some forex positions on now, but in general, I like to trade stocks and I like to trade look for those inefficient markets such as an IPO or a biotech or something that has the potential to make a large move over a short period of time. And again, you can only predict short term when it comes to the markets, but you can stick around longer term as long as the position moves in your favor. So I'm slotted as a swing trader, but sometimes we'll have positions on for as much as 2 or 3 years. Okay, Cameron, let's go back to you. Question number 2 is, based on any technical fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower this week, and it's the close of February 6th?
Higher.
Higher, okay, and that's a pretty good. That's a good answer. That's all right. I didn't have to pin you down on that one. Now, rate your confidence in your answer to question number 2 on a scale of 0 to 10, with 0 obviously being no confidence and 10 being extremely confident.
Sure. I'm about at a 7 this week. We do got some news. Thursday, I think, was that unemployment comes out, unemployment on Thursday. But I think we've had a good pullback here, consolidated. I think it's time to see this thing move up a little bit. I think earnings are going to help that as the week goes on. And you know, Thursday is a big surprise, the unemployment numbers. But I think we've got support down here around 1970. I think if it's going to hold that, then I do think we're going to see little higher numbers by the end of the week. Of course, unemployment can change all of that.
Sure.
And I'm thinking we're going to go higher.
Yeah, and we'll get to the events too in a few minutes. So maybe we could flesh that out a little bit more on the last question here. Let's go over to you, Rob. Rob Hanna of Quantifiable Edges. Based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower this week? And that's between now and the close of Friday, February 6th. And also, let's just give you the second part of the question too. Go ahead and rate that on a scale of 0 to 10.
I'm looking for it to go higher. I've positioned myself to take advantage of a bounce here. We're pretty low in the short-term range, and the long-term trend doesn't seem to have broken quite yet based on a number of technical indicators I look at. So I'm still looking to get a little off of a bounce here. I don't have a whole lot of historical studies active right now that go beyond today. I do have a few from last week. For instance, the Fed on Wednesday, when the Fed announcement came out, the market dropped for the second day in a row. And just seeing that happen, where you know, Fed days have historically been strong market days. A very good percentage of the time, you see the Fed. You see the S&P rise on a Fed day, and it got creamed the last Wednesday when the Fed announcement came out. And so, if you don't see it rise on a Fed day, that's often a sign that you're going to get a bounce in the coming days. I looked at all other times since 1982 where it was down 2 days in a row going into a Fed day, and when you look out 6 or 7 days later, it was up between 76 and 79% of the time. So you got a pretty good chance of a bounce here, and we're still right in that area of where it was last Wednesday. You had to move up on Thursday, move down on Friday. We haven't decided yet today, it doesn't appear. So I'm still looking for a bounce off this level, and I'm not seeing anything that's saying strongly bearish tendencies are in play for the next few days.
Okay, cool. And the confidence? Your confidence on that, 0 to 10?
Probably around 7.
7. Good job. Okay. Vince, let us know, based on any technical or fundamental indicators you want to use, would you predict that the S&P index will move higher or lower by the end of this week, ending on Friday, February 6th?
I think we're going to see the weekend on a lower note. I do think that longer term we're still fine. Looking at the weekly and the monthly charts on the S&P, I think we're still doing well, but we're actually pulling back and testing some key levels both on the daily and the weekly charts. But I am seeing, even though the last little while actually, since about mid or early December of 2014, I mean, there's been a lot of back and forth, a lot more volatility than I would normally like to trade in. But we are gaining momentum to the downside on the daily charts, and I really think from a level perspective, 1960 is key, and I think we're going to test that before moving higher. But that is a key level, and if we don't hold that, we are going to definitely move lower. But what I'm also looking at is the Japanese yen, and right now the Japanese yen has been making a turn higher on the daily charts and trying to make a run for a previous high in around the 86.6 level, and that's really the key. I think I'm keeping a closer eye on the yen than I am on the S&P chart, and if the yen starts gaining more momentum, I think that's going to put even more pressure on equities. But for this week, I think if anything, we're going to make a move or a run for that 1960 level on the S&P. And from a confidence perspective, I got to agree with the other guys. I'm in around a 7 on my opinion this week.
Okay. It's interesting you bring up the yen. I'm actually short dollar yen right now. I think it looks like it's rolling over in here. Maybe I'm just talking my position, but so that means a higher yen. What's kind of interesting is that intermarket technical analysis is a really cool thing, but it only works when it works, and you have to watch for those couplings or decouplings, and in this case, an inverse relationship. So I always learn, like I said, each week I do this, I always learn something. So I didn't think about the connection between those two, so I'm definitely going to connect the dots and see what's going on there after the show. So I appreciate that from you, Vince. I'm going to go ahead and say we're going to get higher this week. I don't really have any sort of setup that I follow directly that's saying that. A couple things. We are oversold in here. We are towards the bottom of the range, and I wrote this morning in my column that towards the bottom of a range, it's going to look a little ominous, and there are some things out there that are pretty scary that I'm going to flesh out when we get further in the show and talk about our reasoning a little bit more. But I think the whole world is watching 1975. It's come up a dozen times on this show recently. I think it could be a self-fulfilling prophecy, but also it's not a line in the sand. It's not a switch that's going to get flipped. In 1975, in the S&P 500, that's the December lows or thereabout, and it's also the 200-day moving average. As I say quite often, a lot of times a lot of technicals come together at the same point. So everybody that brought it's kind of like Pinocchio being a bad motivational speaker. It's like everybody knows that. So I think one plausible scenario is that we probe below 1975, and then when it doesn't follow through, the shorts scramble to cover. Now, I'm not betting on that directly. I'm still long quite a few equities, and I don't want to get knocked out of my position. So I'm going to go higher, and I'm going to agree with everyone else, and I'm going to give it a confidence of about 7 on that. Okay, now the next question is to flesh things out a little bit, and let's go back to you, Cameron. What developing events, and they can be technical or fundamental will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, like I mentioned before, I think earnings are going to have an impact on it. But I come back. I agree that we're oversold. I'm more technical in nature than I am fundamental. But this market's been unusual. It seems that anytime there's any type of good news, we get a sell-off, and then when there's bad news, it starts to run again. It hasn't made any sense. But as an options player as well, I love this volatility. It's been good. But I'd be looking at I think earnings are going to have a play. If they are a little sour, then I think they're anticipating pretty much positive earnings, positive reports. But if that thing turns negative, I think we'll see some more sell-off. We'll definitely test that 1975, 1970 area. But then we got unemployment coming on Thursday. Again, another key number that I think we'll get response to one way or the other. So those are the two major things, I guess I would have to come back to say: earnings and unemployment. Those are the two things to be watching out for. Of course, from the technical stand, if we get down around that 1975, you better just be watching there to see what we're going to sell through that or bounce back up.
Interesting. I was involved with a bond fund for about 14 years, and in that process, I learned that they don't go out and ask everybody, go door to door and count, hey, you have a job or you don't have a job? Did you lose your job? It's a computer model, and it's amazing how this computer model that they run has this huge impact on the markets. And it as far as I'm concerned, it's meaningless. It's just a model. You really think you could know that 1,000 jobs were created? There's about 300 million of us here in the United States, but it is fascinating, and it does obviously move the markets. Rob, let's go after you. let's go to you now, buddy. What developing events, and they can be technical or fundamental, I know you're a technician, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Yeah, well, like you pointed out, I'm more of a technical analyst. So as far as I'm concerned, it's not really the news, it's the reaction to the news that I pay attention to.
Yeah.
So the employment report, I'm with Cameron on that. That could be a market mover this week. It normally does get the markets moving, at least for a day or so there. The reaction to that has been strongly positive for the last 2.5 years. So no matter what the report's been, you've generally had a kind of a hot streak on employment days. And we'll see if that continues or not. But also, like you guys, that 1975, the 200-day moving average is something I'm looking towards. And the reason for me is that a lot of the studies I run do use the 200-day moving average as a filter. So what I tend to see is that when you get locked into a long-term downtrend, in other words, we're below the 200 and we're there for a while, a lot of the tendencies that the market has tend to reverse. So Dave, as a kind of a reversion to the mean with a long-term trend in the back type trader, you're going to be, or a lot of people will be shorting into rallies rather than into buying into dips. Once you get that trend headed lower. So that's the kind of behavior I'm looking towards. Are we below the 200-day moving average? Eventually, is that golden cross going to turn down into a death cross and those kinds of things? But this week, the 200 MA, the VIX also, I'll be watching to see if that pokes up to a new high, and then reaction to the employment report.
Okay. Yeah, the 200-day at the time below, and I'll flesh this out a little bit more in a minute, but years ago I was doing some consulting and programming on the mechanical side, and if we ever had a system that didn't work, if I would report back and said, well, it doesn't work on the short side, it works on the long side, the answer was always, we'll put a 200-day moving average in it. It only takes shorts if you're below the 200-day moving average. And 9 out of 10 times it would start working on the short side. So that became part of the rules. So if you looked at the rules from the systems that I helped co-develop, the 200-day moving average often found its way into it. So it's kind of a simple but an interesting and useful tool. Before I go on that, let's not forget about Vince over there waiting patiently. Vince, what developing events, and they can be technical or fundamental, will you be watching out for this week? And that's obviously the close of February 6th. That might have a positive or negative impact on the S&P 500 and other U.S. markets.
Just like Cameron and Rob, I got to agree. Earnings and the employment numbers at the end of this week are going to be key. For me, this earnings season, I think if I look at the reports, it's more of a mixed picture than anything. But I think what really stands out to me is the perception on the street, and I think the perception has been a lot more negative on those earnings announcements than positive. What stood out to me in the last couple of weeks is, we had a nice jump on Netflix, Apple, and Amazon this past week after earnings, yet the market was not able to gain footing and move higher from there at all. So I think unless we have a real slew of positive earnings coming up, I think that's going to have a negative impact on it, and the employment numbers at the end of the week are really going to be key, I believe, as to how we end this week. So again, I also look at technicals. That's my main thing, and even though there's that 200 MA in around that 1970, 1975 area, I'm still looking at 1960 as the crucial retest. That's for us here at Trading Winds a very significant number or level, and that's what we'll be looking at for the end of this week.
Okay, cool. I like the fact. Well, first of all, I agree with Cameron, who said it's a reaction to the news and not the news itself. In that, I'm 100% technical trader. So as far as the technicals are concerned, again, everybody that brothers watching 1975 present company included. One scenario, I think it would be a dip below that, and then we come right back, as I said earlier. And the reason I say that is if you have a base, and Rob, maybe this is something you could test out someday, but I've seen this happen quite often. You have some sort of base in the market, and you see a breakdown below that base. A lot of people pile on real quick, but if it doesn't materialize, you could actually buy the top of the base when it breaks out to the top. It's like it shakes everyone out that's convinced the market's rolling over, and then the market goes on to make new highs. So part of me is thinking that might happen, and I think there's a part of me that's hoping. I think, as they said in Market Wizards, it's either intuition or into wishing, and maybe it's a little into wishing, but I do think that it seems like every time this market has a downtick, and this is a bad idea to rush out and buy markets because of this, but it's kind of interesting. It seems psychologically every time the market has a downtick, everybody goes crazy bearish. I've got all these bearish emails over the weekend. Towards the bottom of the range, it's going to look like the end of the world. Towards the top of the range, it's going to look pretty good. So again, let's keep watching that 1975. The other thing I want to point out is just like the longer you stay below the base, the more credence is given to that base. As Rob pointed out, the longer you spend below your 200-day moving average, the more important that moving average is. If you look back to October, we dipped below it, but we only stayed a few days below it, not even a week, and then we came right back above. So if we dip below it and we're back up within a week or so, I think we're okay. One thing that's real simple, and if you get a chance after the show, take a look at your charts. If the lows are higher than the moving average, I call that daylight. If the highs are below the moving average, it's also daylight, but on the downside. So the more daylight you have, the more the trend begins to develop. And if you'll look at the S&P 500, we broke above the 200-day moving average after dipping below it back in 2013, and we didn't dip below it until October of last year. And then now, of course, we're testing it one more time. So it's a time below. If it just goes back down, has a shakeout, and it comes right back up, I think we may have dodged yet another bullet. Rob, one thing I want to ask you real quick. You said something that I've quoted quite often. You said that obviously since 2009 the market has mostly gone up, and people have drank the Kool-Aid thinking that we're always going to go up. You said that the Fed has thrown more and more money at the market and reached diminishing returns. What's going to happen now that they've tapered off?
Yeah, well, that's something I've been watching pretty closely, Dave. They stopped pumping at the end of October, for the most part. So the QE program ended then, and the QE program basically it pumped a bunch of liquidity into the economy, and that liquidity found its way to the stock market. So what ended up happening is every time we had a little bit of a dip, it seemed, the market would find its footing and then push higher. And between QE and the good vibes that came from it, we saw a really historic bull market over the last several years. Now, QE's ended, but the Fed really hasn't totally stopped pumping because they're putting maturities back in, right? So they're not really when maturities occur, they're not just saying, all right, well that thing's matured and we're just keeping the money. They're reinvesting. So there's an account that the Fed has called the System Open Market Account, and you can see it on the Fed's website. And I tracked that pretty closely, and since October, it's continued to rise, the amount in that account. Now, it did drop the last 2 weeks, so we'll see. If it begins to roll over, or even if it flattens out, every time it's flattened out or rolled over since 2003, you've had some type of intermediate term pullback. The market's really struggled. To your other point, Dave, I just got one comment on, you mentioned the fake out of a base. And I've seen a few people talk about how the S&P is in a bit of a triangle formation right now. It's not a perfect triangle, but you can see it's been kind of narrowing as far as the ups and downs. I did do a study of triangles a few years ago, and what I found is that the classic way to play them is when you get a break out of that triangle to go ahead and try and buy that break or short that break if it goes down, and then you can target the distance from the break to the original apex of the triangle. Well, I ran some studies that looked to do just that, and then they would put in a stop at the high of the triangle if you were going short, or at the low of the triangle if you're going long. And what I found is about 2/3 of the time, the breakout was the wrong direction. So you normally had a fake out and then a move the other way. Yeah. About 2/3 of the time. So if we do get a move lower here, like you're saying, I think there's still a good chance that you get to move back up. But if we break out to the upside, we might have some trouble down.
Yeah, it can be kind of perverse. You know, I'm surprised nobody last few weeks the big theme has been oil, and nobody mentioned oil. Any comments on that from any of you guys? Cameron, Rob, Vince?
I think oil is going to continue in this area here. It'll probably test its low again. I think we're in this area here for the duration of the winter until we actually see it start to slowly work its way back up into the 60s. But I think that's not unique thinking on my part at all.
No, actually, it's Vince, and I gotta agree with Cameron. I share the same opinion. I don't think we've seen a bottom on oil yet, and if anything, I do think we will retest those lows in the near future. But I do agree. I think we're going to trade in a range on oil for several months.
Well, I think oil is in the process of bottoming, which doesn't mean that it can't go back and test the old lows. I think it's lost a little bit of its downside momentum. But I'm a trend guy, and I'm always a little late to the party, so I'm not calling a bottom just yet. I watched gold for a long time, for months and months and months and months, and then finally we got a signal to the upside. But the thing I was alluding to was last few weeks, a lot of people had equated lower oil prices with just the opposite of what you would think. Everyone thinks, well, the economy is going to improve and things will be better and the S&P will go up because of that. But their arguments were that companies are going to go bankrupt, banks are going to go down, and it's going to get uglier. So it's interesting that no one's mentioned that. Or do you have any opinions on how oil could impact the S&P 500? And anyone can jump in on this.
Sorry, Dave, I don't have any strong opinions on oil.
No, that's good. That's good. No, that's good. Good stuff. No, well, what concerns me now is a few weeks ago someone said that the oil companies could start going out of business that are very leveraged and depending on very high oil, and I never thought about that aspect, and that could make banks go out of business, and that could trickle throughout the system. One thing I have been noticing that's got me a little worried about this market is that the banks did break down late last week. They've been kind of breaking down for a while, but they've been bouncing, and then we hit multi-year lows on on Friday, so that has me a little bit concerned about that. Okay, Cameron, let's go over to you. When you place trades, do you use stops for risk management? And if so, how do you decide where to place those stops?
Yeah, all the time. When I go into a trade, there's no CO right behind it with my targets and my stops. Yeah, I trade the S&P E-mini when I'm futures trading. The software that we're using, I come in with an initial stop because I'm scalping. I'm just a scalper. I'm in a trade a minute to 5 minutes. So I'll come in with a initial stop of about 2.5 points, and then I'll immediately manipulate that to the Danton stop. I like the Danton stops, and then I just wait and let as long as I don't see anything negative with my trade, I'll just let that strategy play out. But yeah, every time I'm in a trade, I've got to stop back in there, and I got my targets placed, and if there's no reason to manipulate that trade or management in any other way, I just let it go and just stay with the Danton stops throughout that trade.
And what is a Danton stop?
Well, that's a good question. There's a large body of work on Danton. And I'm not actually sure how it works. Our software indicates where that is. And we've got a variety of different stops that we can be using, pivot stops, pivot points, or the Danton. We've got one-to-ones. There's a lot of different areas where you can find places to put that. But I can't really tell you why it works or what it is. I just know it's out there. And
well, you could, but you'd have to kill it.
For that, yeah, well, I couldn't even do that, to be honest with you. But I know it works. I don't, the old saying is, sometimes you don't, I know how to drive the car, I don't know how to rebuild the engine.
Amen.
Anyway.
Flip the switch, get electricity. Don't worry about how it works. I hear you. No, I fully hear you. Okay, cool. All right, Rob, to you. I think I know the answer ahead of time, but everybody else won't or may not. When you place trades, do you use stops for risk management? If so, how do you decide where to place those stops?
Well, first off, I misunderstood Cameron for a minute there. I thought he was saying I stick with the damn stops.
That's what I thought too. I'm glad he repeated it because I don't look stupid asking that question. But yeah, same here.
Well, it really depends on what kind of trade I'm taking. So most of my trading involves swing trades, and I do not use stops for them. And the reason is that I've done a lot of studies and have found no way to improve my odds and my long-term returns using stops. In fact, in nearly every case when I've tried to incorporate such stops, it's hurt returns quite a bit. And not only has it hurt overall returns, it has made the worst trades worse. So, for instance, if you are the primary reason for using a stop is to avoid the block swan, right? You don't want to get creamed on one position and then knock your account silly. So what I've done is saying, all right, if I incorporate stops using this swing trading methodology, what's the worst trade going to be? And if I have a 5% stop or a 10% stop or a 20% stop, oftentimes that stop would have gotten absolutely blown through because you'll get a big gap down overnight, or you'll get something like that happening where the stop would not help you in any way. You got to remember the market's closed about 3/4 of the time, so you're open 6.5 hours a day, and most of the news is coming out after hours, whether it's economic news, whether it's earnings reports, anything like that. So stops don't help as much as we'd like them to. If I got a position big enough that I need protection, then I'll use options. Now, for my overnight futures trades, I do incorporate stops because I got a fair amount of leverage there, and so I'll put in a stop. But I've tested my stop levels, and they're pretty wide. those stops will get hit 3 to 4 times a year, and that'll give me the best chance to have that trade work out. And if it doesn't, then I know what I'm going to lose going in.
Yeah, a little bit different style. Years ago when I did do a lot of mechanical testing, I remember when I first programmed my first mechanical system, got all excited, says I can't wait to put stops in it to see what's going to happen. And to my surprise, it actually hurt performance. But I'm a big fan of stops. We'll get to, I'll explain that in just one second. But let's go over to you, Vince. When you place trades, do you use stops for risk management? And if so, how do you decide to place your stops?
Yes, we absolutely use stops all the time. And again, as I mentioned earlier, we're very conservative here at Trading Winds. So typically, with most of the systems that we have and teach here, we limit our stop or our potential risk to the range of the setup bar. In other words, once we identify that setup bar, we're looking for a trade above that bar to trigger us into the trade, and if we do, our stop goes just below the low of that same bar. During times of increased volatility such as this, sometimes we might stretch that out a little and move it to a previous low. But again, it'll be fairly tight. But for us, the key are the rules that we wrap around those setup and trigger conditions. And we've been able to come up with a set of rules where actually most of the trades that would not have worked out are not even losing trades. They would just be negated trades or disqualified trades ahead of time. So we don't have a huge issue with getting stopped out very often. And when it comes to trading options, we typically use a 50% stop loss on an option contract. So if we buy a call option, for example, for $3, we'll have a hard stop at $1.50, even though we're managing the stops off our charts based on the actual systems, but we will carry a hard stop on an option contract regardless.
Okay, interesting stuff. I'm a big fan of stops, but I think they have to be placed outside of the normal volatility. I wrote an article years ago. It's floating around the internet somewhere. It may be on my website. I'll have to dig for it, but it's called The Myth of Tight Stops. And I think you have to have a stop wide enough to survive the short-term volatility, and that's sort of what Rob's doing over there with his short-term trading, from what I can understand. By not using stops, he's got some sort of he's outside of the normal volatility because he's getting out within a short period of time. The secret sauce for what I do, which is after stock selection, obviously you want to pick the best markets to be in to begin with, something that trades nice and cleanly and tends to persist in the direction of the trend. But the secret sauce, from what I've seen, and after I've showed it to a lot of people and worked on some of these institutional projects, is that if you could survive the short term and get a short-term profit out, you could allow that remaining stop to open up via a trailing stop. And let's say the market goes up $1.50, whatever the market they may be, and maybe you bring your stop up by $1 instead of $1.50, instead of trailing it in a lockstep fashion. So what you're doing is you're slowly transitioning from that swing trader to the longer-term trader. The real money is in the longer-term trend, but as I said in the beginning of the show, you can only predict the short-term when it comes to markets, but you can certainly stay around, and I hate to use the word the market's money, but for lack of a better term, you can play with the market's money through an ever-widening, to some extent, to a reason, trailing stop, and that allows you, again, to transfer from that swing trader to the position trader where the real money is. As far as where to stop, where to set them, the answer I give a lot of people, and I've got flooded literally last week with a bunch of emails on this, is that I simply eyeball the charts. And if a stock is moving around 4 and 5 and 6 points a day, my stop has to be outside of that volatility. I was speaking in San Fran a while back to the TSAA, and one guy was arguing with me. He says because of a popular method, which you've probably heard of, I'm not going to mention the gentleman, but uses an 8% stop. Well, saying that we should all use an 8% stop, I explained to the guy, was like saying that we should all wear medium shirts. And I haven't wore a medium shirt since I was about 5 years old. You know, there's no way my fat ass is going to fit into that. But you have to take each market into consideration on how much it moves. And I fixed a lot of people, and I didn't make any money in doing it. You could spend $10,000 and mentor with me, or you could pick the best markets to begin with and use a little bit looser stop, and that'll help to keep you in that position longer term. And I did, just last week, ironically, I did a show, and all we talked about was stops for an hour and a half. So if you're interested in that, if anybody watching this, it's on my YouTube channel. And if you're watching this on YouTube, you should be able to link to it from here. But it's youtube.com/C as in Charlie or C as in custom /Dave Landry if you want to watch that. And just one more quick point. Whenever I do speak somewhere in person, afterwards, as Rob knows and you other guys Cameron and Vince, after the show, of course, the people flood the stage and ask a bunch of questions, and 9 out of 10 questions are about the setups because everybody's all excited. Everybody's a setup junkie, excited about setups. Rarely does anyone ask about money management. When that one person does, I know that person is either made it as a trader or is getting pretty close to making it. So the person who's mostly interested in money management is probably very close to making it as a trader. So I'd encourage anyone out there, especially if you're newer to trading, to focus as much on money management, at least early on, as you do the methodology. Okay, Cameron, let's go back to you. Any closing thoughts and anything else you want to mention to us about DimensionTrader.com?
No, I agree with you on that, on the money management. We preach that also. And one of the things we found is people don't stop, especially new traders. They're experiencing a little success during the day, and I'm talking about scalping. They just keep going, and more often than not, you give it back. So set your goal and stop when that goal is met. Whether it be if you're having a bad day, stop. Don't keep trading. Don't revenge trade. And whatever that is for you, whatever you've established as whatever your risk is, whatever your reward is. When you achieve either one of those, stop. Go play tennis, go play golf, go to the beach, or go skiing. Doesn't matter. But don't give it back. Hard to make money. Keep it when you've made it. No, I encourage people come take a look at what we've got. It's a great little scalping system. It's at DimensionTrader.com, and we do run an open class on Monday, Tuesdays, and Thursdays from about 9:30 to 11:30 each day Eastern. And it's called the Easy Trader Training Room. And you'll see on our homepage how you can register for a free guest pass and come in and take a look at us for a week. And then all of my stuff is contact information's on there. It's Cameron at DimensionTrader.com. But I'd love to chat with you about it. But it's a great little scalping system. We like it. We have a lot of traders using it and a lot of success behind it. And we teach how to do it. We teach you how to trade. Cool.
I heard a cell phone go off. Somebody's getting a margin call. Don't answer it. Rob, let's go over to that's whenever I'm speaking somewhere, the phone goes off. That's what I say. Hey, margin call. Hey, Rob, let's go over to you, buddy. Rob Hanna of QuantifiableEdges.com. Anything else you want to tell us about? Any closing thoughts, I should say, or anything else you want to tell us about easy for me to say, QuantifiableEdges.com.
You got to practice that, Dave.
Yeah, I know.
Just one other comment on using stops. While I don't use them, you do need to know when to get out. So it's not just a matter of riding it to whatever your target is. You got to get out at some point. So my basic philosophy with the swing trades is if I have an edge, I get into a trade, and when that edge isn't there anymore, I get out, and that edge might not be there anymore if it goes against me or if it goes in my direction. But you got to be a little. So I step back and evaluate each night. And take
well,
kind
yeah,
of a day by
that's the thing I want to flesh out a little bit with you, Rob. Just because you're not using stops doesn't mean that you're not using some sort of damage control and money management, and
right.
and you're taking signals off a system. So that's a little bit more involved than what the novice might be familiar with. But you're trading within your edge, and you understand your edge, and that is your stop, so to speak. So
right. Now, as far as quantifiable edges, anybody has any further questions, feel free to contact me at support@quantifiableedges.com or support@overnightedges.com. Overnight Edges, I I mentioned this to you probably a month or so ago, Dave, but it has now merged with a site called Master the Gap, and Overnight Edges, and that's Master the Gap does intraday setups on a quantitative basis. Overnight Edges does overnight setups on a quantitative basis. So we're going to be launching a new site hopefully within the next month, and I believe it's going to be called InvestaQuant. It's going to be kind of 24-hour, you trading during the day or trading during the night type thing.
Cool.
So that should be exciting, and I will I'll have plenty more news on that. So, like I said, you can contact me at quantifiableedges.com, overnightedges.com, or if you want to have a detailed discussion, just show up at my house this afternoon with a snow shovel, and I'll be happy to talk all you want.
Yeah, God punish me. I was replying to somebody on Facebook that's up in Boston, and they had the before and after, whatever you call it, blizzard. I don't even know what they are. And I said, yeah, my door's open. I got some shorts on. It's really bad over here too. Okay, yeah, Rob, good stuff. And it sounds like those two websites dovetail together, kind of like the peanut butter and the chocolate with the Reese's. So congratulations on that.
Thank you.
All right, Vince. Vince Vora of TradingWinds.com. Vince, you got any closing thoughts for us? And anything else you want to tell us about TradingWinds.com?
Sure. First of all, I've been wanting to say this from the start, but I wanted to tell Rob that I love the hat. We love to have some fun here at Trading Winds, and this past week we actually had a Super Bowl promo that revolved around Tom Brady actually scoring the first touchdown, carrying the ball over the line himself, which didn't happen, but the Patriots won, so it was all good. But yeah, I mean at Trading Winds, what we're trying to do is simplify trading and save people years and years of trial and error and those expensive market taught lessons that most of us have unfortunately been through. So we're all in search of the Holy Grail, and many of us have spent the years trying all the different indicators and so on, all the different strategies, and what we've done is narrowed it down to something very simple that is easy to use for most people, regardless of their level of experience. And so what we'd ultimately like to do is just give everyone a look, have them look over our shoulders, see what we do. And if you go to our site, TradingWinds.com, TradingWinds.com, you will see a trial option, a 14-day trial for $7. For anyone watching this show here, we'd be happy to extend that to a full 30 days so that you can get a really good look at what we do. And if you register today, you'll start receiving the nightly videos this evening. I just encourage you, once you do sign up, you will receive an email that says confirm. Click here to confirm your email address. You must click that or you won't be receiving those emails. But we are similar to Rob, swing traders mostly, U.S. equities, options. We like to keep things simple and consistent.
Okay, good stuff. Yeah, once again, we don't have a controversial show, so it seems like everybody's got what I would call a conceptually correct approach to the markets. I have an educational site, DaveLandry.com. I do answer all of my emails, Dave@DaveLandry.com personally, so if you have any questions about anything that I'm doing, let me know. I do keep things simple. Again, I trade pullbacks, add short swing to intermediate term, and hopefully even longer as far as the holding times. And in answering the emails, if you have a more complex question, I do a weekend charts, which is every week. It's about an hour and a half, sometimes a little bit longer. And those lately I've been posting those to YouTube, but the show is free to come to, and I'd encourage you to stop by the show and check things out if you have any questions or if you want to see the methodology in action. And also, if you want to see what I think about your current stock picks, bring those to the show too. Let's go ahead and, I guess, wrap things up. I appreciate everybody, you guys joining me here today. Once again, Cameron Yost of DimensionTrader.com, Rob Hanna of QuantifiableEdges.com. How's that, Rob? And Vince Vora of TradingWinds.com. Let me turn it back over to you, David. Once again, thank you, David Kosmider, for having me today as a host once again. And thanks again to TimingResearch.com.
Thanks, everybody.
Hey, thanks, guys. Yeah, great show. I want to remind everyone that if you haven't seen the current report, or if you want to see any of the previous reports, just go to TimingResearch.com/reports and download them there. Also, be sure next weekend, sometime before Sunday afternoon, go to TimingResearch.com/current survey and fill out this week's survey. And again, just want to thank my guests for the week: Cameron Yost of DimensionTrader.com, Rob Hanna of QuantifiableEdges.com, Vince Vora of TradingWinds.com. Thanks for being on the show the first time. And Dave Landry of DaveLandry.com. Thanks for guest hosting for me again. So, thanks, guys.
Thank you.
Thank you.
Thank you.